March 2025 macro webinar, The Tightening Ahead. It's been quite a time over the course of the last couple of weeks since we last talked in terms of the evolution of both the policy dynamics as well as the market response to those policy dynamics. For those of you who follow along with these on a regular basis, as you know, we kicked off the year with the overall outlook that we called Curb Your Enthusiasm, where we saw that the expectations that were priced into the equity markets, in particular, and to some extent in the bond markets, were just too strong relative to what was likely to play out. And in particular, as we highlighted last month, in the context of what looked like a deceleration or a tightening that would lead to weaker growth ahead based upon the series of policies that we're seeing out of the new administration. What we saw in the last couple of weeks has been a market recognition of those shifts happening and it flowing through to asset markets as expected, with stocks underperforming bonds meaningfully over the last couple of weeks. And so now as we turn our attention to what's going on, things are pretty fast moving, and we're looking at whether or not the totality of the tightening dynamic that we are seeing play out in terms of the policy mix is yet fully reflected in the bond market and in the stock market. And it still looks like there's possibly room to run there. So let's get into it. There's been a whole series of different policies that are related to increased tightening. The first, we'll just get started with the Fed. For a while, there was the expectation that the Fed was going to engage in an aggressive cutting cycle. What we saw to start off the year, and we saw in Fed rhetoric, was concerns about engaging in an aggressive cutting cycle given the risks of an inflationary pressure coming from the policy response, combined with the fact that actual reported inflation numbers were above what their expectations were to kick off the year. And that initially, to start off the year, really created an effective tightening of almost 100 basis points of scaled back easing expectations for 2025. Now, just in the last couple of days, that started to shift. But just because we're starting to see moves in the rates market doesn't necessarily mean the Fed is actually going to comply with that, particularly given the fact that the data that we've seen come out so far has not been particularly the inflation data, has not aligned with them shifting back to a cutting cycle. And so, we're probably in a state where monetary policy is probably tighter and slower moving than if they were solely responding to growth. Then we look at what's going on the fiscal policy side, and the incremental information that we've seen in the last couple of weeks suggests further tightening. So one aspect which has been a real question is, first of all, would the TCJA get extended, which, mostly looked like that was going to happen based upon, expectations and the administration as well as congressional Republicans' views. The question, and that just the TCJA extension, as we talked about last month, doesn't really matter for economic activity because it's already current law. And so simply by extending it, you're going to maintain the existing path of spending and the existing path of incomes rather than meaningfully change it. So the real question is, if it gets passed, what are the pay-fors that are going to happen in response? And we started to get some clarity on that related to the budget process over the last couple weeks, which suggested that there would be something like $1.5 to $2 trillion of spending cuts that would come in order to at least in part pay for the TCJA extension. Now, those cuts, the $1.5 to $2 trillion of cuts, just for context, would be over a 10-year time frame. So we're talking about a couple $100 billion of cuts, close to 1% of GDP in terms of total impact. Those cuts in particular would be in programs that typically are either transfers to or spending on high propensity spending cohorts, lower income cohorts. folks who are receiving things like SNAP, food stamps, income assistance, disability, and Medicaid. All of those are programs for lower income folks in the US. And that's important because the economic impact of those cuts is relatively meaningful, has a relatively significant multiplier in a way that the possible benefits that could come from maybe some tax cuts that are in addition to the TCJA extension, it's just a lot bigger drag than it is benefit. Um, and in many ways, when we look at what the budget process came up with, it's kind of the worst of all worlds in the sense of you have simply an extension of current law on the tax cuts, which means that you're not really getting any stimulation, those sort of things that were talked about on the campaign trail that might lead to additional stimulation, like no tax on tips or no taxes on Social Security income. Those were excluded from the budget process. So you get no real tax relief. You get spending cuts to to high propensity spenders from lower income cohorts. And you get a continued widening of the deficit because the pay-fors are not sufficient to offset the impact of the tax cut extension. So you get a widening deficit. That's about as bad a combination as you could get because it's negative growth and leads to a tightening of financial conditions in that combination. There is the possibility, of course, that we see further cuts than what is proposed in the budget, and that could come from the DOGE process. Now, we talked about the DOGE process last month, and I highlighted then that while there's a lot of rhetoric about the DOGE process, the overall spending impact so far had been somewhat limited, and we continue to see that into the first couple weeks of February as well, where overall spending by the government in 2025 is not all that much different than over a matched calendar time frame in 2024. While the DOGE process, meaning the contract cutting and USAID cuts and things like that, is not likely to be substantial, the thing that is increasingly clear is that there is going to be a rather substantial set of employment cuts across the government in the coming months. So we've already seen about 40,000 specific announced job cuts across the government, combined with something like 75 or 80,000 folks who are taking the buyout. And that's likely just the tip of the iceberg in terms of the planned reductions in force that are going to come in the government. I mean, something as simple as simply cutting the federal workers who are in their probationary period would be about 250,000 job cuts, or that would be, between 2 and possibly even 3 months of employment gains, payroll gains. And so that would be a meaningful impact on the labor markets for a labor market that is actually, that's growing pretty slowly. On top of that, we're increasingly seeing signs that contractors, which in many cases are even, larger share of employment impact, are starting to scale back their hiring intentions because of the fact that they believe that at some point they will receive cuts. And so these contractors and consultants who support the government and its efforts, the private sector employment that supports the government's activities, is already starting to feel the pain. And so we see at this point anecdotal evidence that that's happening and that may very well extend into the future. On top of that, there are likely some indications that we're going to see over time a tightening in the debt profile that we see from the government. Really, two different angles here, which is the Federal Reserve making some real clear statements in the last couple of weeks about how they intend to adjust their balance sheet to have it match the debt profile, the overall debt profile of the outstanding Treasury debt. Right now they are overweight they are overweight. The Fed is overweight longer dated securities relative to short dated securities relative to the overall debt profile as a function of their various QE programs. And so, if they were to simply transition to hold a higher share of short term debt relative to long term debt, effectively that would mean that more long term debt would come into the market that would have to be financed by the private sector and would require the private sector to sell other assets and buy that longer term debt. Now, this is probably not likely to be an acute move, but on the margin, it sort of extends the concept of the QT process, even if the QT process starts to roll off probably by the third quarter of this year. And the way that it does that is essentially through a reverse twist. For those of you who were around trading markets back in the tens, the Fed in a stimulative activity did a twist, which is they sold out of shorter term bonds and bought longer term bonds. This is essentially the opposite, which is selling out of or reducing the share of the portfolio in longer term bonds and going to shorter term bonds. And look, overall, various Fed officials have made a statement that they may want to even move to essentially 100% short-term paper, just as they were, back before the financial crisis, which would mean a lot of duration supply coming into the market that would have to be eaten up by the private sector. In addition, what we're seeing on the right-hand side, while Treasury Secretary Bessent in recent weeks highlighted that he was not that interested in terming out the debt, even at this point, we're still seeing a lot of bill issuance relative to bond issuance. And so any normalization of that process that comes in coming quarters would be an on the margin tightening. So we're seeing a Fed tightening, essentially relative to what was previously expected, or tighter Fed relative to what was previously expected. We're seeing tighter spending policies, and we're seeing tighter financing policies. And all of that is combining with what is likely to be a material effect from the newly announced tariffs today. I mean, we already saw it in the financial markets, the almost immediate, the negative response to the actual implementation of the tariffs across Canada, Mexico, and China that came into effect today. Overall, these tariffs have a possibility of having a relatively meaningful effect on economic activity. On the left-hand side, what you get a sense of is just how significant the proposed tariffs are at this point, and below that gives you an indication of the specific tariff policies that are adding up to those total numbers. At this point, the new administration's planned tariff activities, if they were to all be implemented, which they're all slated to do so in the next 30 days, give or take, would bring the U.S. tariff rate to a level that is higher than it was, the highest level in 100 years, higher than it was basically since back to World War I, and higher than the Smoot-Hawley tariffs. That is quite an acute tightening in terms of the overall tariff policy, and would lead to a likely increase in costs to American consumers and businesses that amounts to about 1.6% of GDP. Now, when you're thinking about tariffs, the question is, does that flow through into higher prices, or does that just lead to lower real demand and investment? And how exactly it flows through is a question of whether or not households or businesses, and in particular households, have the income growth necessary to pay higher nominal prices. Back when we had a supply chain disruption a few years ago, rising incomes through a combination of rising wage incomes and significant fiscal transfers gave households significant spending power growth to pay higher costs when those prices rose. Today, the situation is pretty different. Labor markets are deteriorating to some extent, and there aren't those sort of large government transfers that we saw in the previous rise in prices. And so it's more likely that when we look at this, it nets out to being a negative real GDP or negative real demand effect than it is an overall then it will drive an overall rise in prices. Essentially, a function of the fact that if you've got to spend on essentials and the prices of those essentials are going up as a function of the tariff policy, there will be cutbacks on other things. So, if you've got to buy a car and it's $15,000 more as a function of the tariff policies, you'll still buy the car, but your demand for various services, say travel services and things like that, will get cut back because your overall spending power isn't going to meaningfully change. And so I think that the question here is less about, are the tariffs specifically inflationary? They're, of course, specifically inflationary to the goods themselves. The question is not, are they globally inflationary? The question is, what happens to real demand here in response to much higher prices for of a lot of goods that don't have an immediate replacement with domestic production. In addition, the drag on the U.S. will also come in the form of retaliatory tariffs that happen as a function of the U.S. implementing its policies. Now, look, so far, the retaliatory tariffs have been very benign, I'd say. China, with 2 rounds of retaliatory tariffs that really haven't had hardly any effect, highly targeted, and a small impact overall. Canada's retaliatory tariffs are slightly larger, but still only on about a third of the goods that they import from the United States. These, if they were to escalate further, could easily create a much more meaningful effect on U.S. export production. And even with relatively conservative estimates, you're still looking at a hit to U.S. exports of 0.5 to 1%. One of the more interesting things about this dynamic as well, that was talked about today, was that it's possible that these retaliatory tariffs may actually flow through back into increasing U.S. tariffs on those countries as part of the reciprocal tariff policies that plan to be implemented by the new administration in 30 days or so. And then finally, for the folks, for the exporters in the United States, this represents a relatively meaningful hit to their economic activity, as I show in the upper right-hand corner there, with the size of the drag being roughly 3% of GDP on Canada and about double that on Mexico, about 1.5% of GDP on the EU. Now, the effect of those things it may take some time for those things to flow through in terms of the scaled back U.S. imports from those jurisdictions, given the higher tariffs. But those are relatively meaningful effects on those economies. And then just going back to the overall picture in the U.S., this is particularly influential. These tariff policies are particularly influential on low-income cohorts, as the propensity, the ability to shift spending is much lower for those cohorts, and so it flows through almost directly into the prices paid of essentials for those cohorts. And the discussion of that is less, it's less important. It's in this context, from a macro context, it's not really about a normative judgment about whether there should be policies aimed at lower income cohorts to support lower income cohorts or higher income cohorts. It's just merely a macroeconomic diagnostic that by implementing these tariffs, they will have disproportionate effect on essentials prices, and that will have a disproportionate effect on those folks who have a high propensity to spend, which means that the real economic drag will likely be more substantial than were it to be a higher effect on higher income cohorts with a lower propensity to spend. This is all coming at the time when we're starting to see signs that private sector liquidity, particularly financial liquidity, is starting to withdraw as well. I for those of you who follow me a fair amount, that I don't have any particular alpha views on things like cryptocurrencies, but I do think there's been relatively extensive work done by a whole bunch of people on, by several FinTwit leaders connecting global liquidity conditions to the price action that we see in those markets. And I think it's interesting to see in the tide of liquidity moving out, or, coming in and then moving out. Often the most marginal assets are the ones that feel the effects most directly and most swiftly as private sector risk taking and liquidity preferences start to change. And so it's notable that we've seen across a wide range of cryptocurrencies in the last couple of weeks. We've seen declines across a wide range of cryptocurrencies, with many of them, many sort of larger benchmark currencies, whether it's Ethereum or Solana and others, totally retracing their post-election bumps. Bitcoin falling substantially from peak and experiencing a substantial amount of volatility, and the universe, or the surge in shitcoin issuance that we saw right after the election, with the surge in a variety of different speculative coins, etc., basically collapsing to zero. All of that suggests that the tide of liquidity that is going out is being first felt by these riskiest cryptocurrencies. And so if you look over there on the left-hand side, while the connection between or the lead between Bitcoin prices and the S&P 500 is certainly not um, fully stable at all times, there is some indication that, or there should be some worry that, to the extent that we're seeing the sort of weakness in the cryptocurrency space, it may portend a weaker set of conditions across the S&P 500. As we, you take this all together, it's like, wow, this is a heck of a tightening. The Fed's tighter than expected. The fiscal policy is tighter than expected. The financing's effectively tighter than expected. The tariff policy, which many people had talked about maybe just being bluff, is in many ways larger than expected and larger than what was discussed on the campaign trail. And I think it's important to recognize in this context that that this is not it does not appear to be a thoughtless or random set of policies. That when you hear the rhetoric from a variety of different administration officials, what you hear is a desire to uh, to curb the excesses of the previous administration, or what is viewed as excesses of the previous administration, and a recognition that pain may be incurred as a function of that, and that they're okay with that. And so I think this meme from Andy, I think, is a good one to keep in mind, that in one form or another, Trump, Bessent, Powell, and Myron have all said in one form or another that they're comfortable with stocks going down. Now and even today, Bessent came out and said he's not really focused on what's going on with Wall Street and the market action that is being seen. That's important because I think a lot of folks priced the Fed or Trump put based on expectations that the strike price would be pretty close to all-time highs. And if anything, what we're seeing across the set of rhetoric is a real comfort about having stock prices or asset prices fall, particularly if it aligns with bond yields falling at the same time. The idea being, that there is a lot of comfort with curbing what are viewed as those excesses of the previous administration. And so in many ways, we talk about take people seriously rather than literally. I think this is a good example where what is serious, what is most likely true, is a comfort with accepting financial market weakness and growth weakness in order to achieve those policy goals. But the exact path is still unclear about exactly how it'll work, and so that's why we have to be consistently re-updating and looking at that policy mix to say what are the incremental policies that are happening and what is likely to be the macroeconomic consequences of it. It's going to be very hard to lead on these policy announcements. I think anyone who thinks that they can get inside the head of um, of these policymakers and predict exactly how they're going to pursue policies ahead, that's a very challenging thing. That said, I think what you can do in this environment is understand the policies well, understand the macroeconomic consequences, understand, let's say, the consistency of policies and the direction of them, the directional consistency of those policies, and then make inferences about whether or not that's priced into the asset markets. And that's really big picture is stocks, global stocks, um, are just off highs. And essentially, there is no reflection of what appears to be a relatively significant coordinated tightening cycle priced into the equity market at this point. And we've even started to see, it's kind of interesting. We've even started to see some of the macroeconomic stats start to turn, the growth stats start to turn even before the likely effects of this fiscal policy tightening and these various tightenings flow through to the real economy. And so you see things in the upper left, like the city surprises index being at post-election lows. You see the Atlanta Fed measure, which is obviously too extreme for some technical reasons around imported gold and things like that. It's obviously the economy is not contracting at 3%, rate in the first quarter, but we have seen indications that demand measures are starting to slow, and that's even before any of these policies really get implemented or we see meaningful government layoffs. And look, this is all a function. We had a rise of stocks and an easing of financial conditions, and that led to a stronger economy going into the election. And then we've seen a leveling off and modest fall in the underlying in the uh, in the asset markets, and we've started to see some weakness in the economic statistics as a function. And so I think it's just important to recognize there is a reflexivity to this, which is that a lot of the economic strength that we've seen in the last couple of years is really reliant on the continued strength in asset markets. As those have stabilized and started to modestly decline, we're starting to see signs that economic strength is starting to moderate. And the risk there is that that is self-reinforcing, which is that the asset market declines lead to less economic activity, particularly consumer demand, which then flows through to asset market declines and creates that negative cycle. In the same way we've seen a virtuous cycle for the last 24 months up until the election, we risk seeing a self-reinforcing downward dynamic on the other side. We're also seeing this, for those of you who follow the followed me for a few years, I've talked a lot about the concept of the income-driven expansion. And the reality is that as the labor market has softened in the last couple of months or year or so, we're starting to see, some meaningful softening of the income side of households, and that's what you're seeing across these charts, which is with a lot of different measures of income that you can go with, whether it's average hourly earnings or the ECI or the Paycheck Small Business Income Survey. All of these point to income growth is slowing at the same time that price growth is picking up a little bit in the recent period, which highlights the fact that over here on the right hand side, real disposable income growth is about as weak as we've seen. It's certainly as weak as we've seen in a couple of years, and on the weaker end of expansionary period of the expansion in the post-COVID era, in the post-GFC period. So this is not a particularly strong set of household income growth that we're seeing here, and that in many ways is sort of even before we get to the weakness of asset markets flowing through to the weakness in demand, we're already starting to see some slowing on the income side. And really the only way in which we've been able to continue to persist this extended demand, household demand cycle has really been through uh, easing of the savings rate, which has fallen, a couple points over the course of the last year. And that's really been an important part of what's kept household demand going, despite the fact that income growth, wages, and salary growth has moderated. And so we're really in this very precarious position where the economy is reliant on consumer demand. Consumer demand is reliant on continued asset price appreciation, and we're starting to see signs that that's not going to continue, and that from a stocks perspective, with stocks just off all-time highs, is largely not priced into stocks. Turning back to the rest of the world, I think what's interesting in terms of what we've seen in the rest of the world is prior to the tariff implementations, the actual real stats that we've seen in these economies, basically seen them beating very, very low expectations. And as a result, we've seen some compression in the differential performance of countries like the Eurozone and Japan and their performance relative to the United States. And this is likely, there are signs that this is likely to continue. I mean, just a good example is the expansionary fiscal policy that's likely coming out of Germany and Europe, in part as a function of their stance on the Russian invasion in Ukraine, and suggesting that these economies may be, while the U.S. is basically experiencing a big tightening, these economies may be making efforts to engage in easing, particularly in Europe, and that may be beneficial to their economies and to their asset prices at a time when their assets are priced very cheaply relative to the United States. And so we've started to see some compression there, but there's some possibility that will continue room for that to compress further.